Okay, welcome everyone. We'll start our third lesson on investment analysis. My name is Anjum Satar and mail address anjum@ukversity.co.uk. If you have any question, please drop me email. And before starting our lesson 3, which will be based on LO3, Learning Outcome 3 of this unit, so we'll a bit recap what we learned during our previous lessons. So lesson 1, we discuss about understand different types of security. So where we discuss about money market and capital market, where we discuss about what is the difference between primary market and secondary market. Any thoughts?
Primary market might be, for example, the first issue. Secondary market is where these have been traded.
Okay, well done.
Securities that have already financial securities that have already been, instruments that have already been traded.
Great, yes. Great. So second lesson, we discuss about how stock exchange work, and we discuss about different types of securities as well.
Yeah.
So we discuss about London Stock Exchange, we discuss about junk bond, we discuss about legislation, we discuss about corporate governance issues within it as well.
Yeah.
Yes, so all these things we discuss second lesson, where we discuss about description, the valuation of forward contract, swaps, what is meant by, and warrant and types of options in securities. Those, the company convertible, and those are secure against different assets. So today lesson will be focused in active content, risk and return. What is meant by risk? Any definition? Can we define risk?
Yeah, it's a hazard, or it's something that may or may not it's a potential risk, or you take control systems in place in the event that it does happen, to mitigate or to substitute the risk.
Brilliant. Risk is a probability of happening something. Yeah. It can be positive or negative. Higher the beta, higher the risk factor, higher the return. Normally we use in business the risk factor, we use the word beta, higher the risk factor, higher the return. So we discussed last lesson junk bonds, different sort of the junk bond. Their rating is quite low in a way, because this can be triple C's, triple C++, D's, and those can be sell in stock exchange as well. Normally is high return, high risk, those are the new companies, never known by the investor before. So that's why is pricing securities, how we can decide what price will be, different methods we can use, market efficiencies. Miller and Morliani gave us is a theory is called strong market, weaker market, and with the market efficiency we can measure it by we discuss about 3 E's concept as well: effectiveness, efficiencies, and economy. So when we decide investment, so it will go through markets and investors, security quoted on the yield basis. Yield is mean return. Normally we use in a farming industry, per acre yield, what yield will be, what will be output of it. So we can say what yield will be on the security. Discount basis, how we can discount against the nominal or the face value. It's a lot of things is there on LO3, but we'll focus some numericals and some a bit generic discussion as well. So that's LO3. When we look the assessment criteria, evaluate the principle of investment theory. So here we'll see and we'll discuss some investment theories of different authors. Evaluate use of securities, different security we can evaluate basis of the risk and return, and then underlying concept of market analysis and efficiency, which we can based on different theories as well. So all this today lesson will be focused on these things. So we'll start our lesson, today lesson. So welcome everyone, lesson 3, which is based on LO3. So what do we know about investment theories? Anything we know? Securities or market analysis? We
Sorry?
ever investment theories? What is meant by investment theory? What sort of the theories we have?
I don't know. I can't remember. I don't know. Until if you say something, I know.
Okay, so whenever we'll invest, we look risk,
Yeah.
we look return, we look present value
All right. Okay.
of future cash flows.
Yeah.
Yes.
Yeah.
And we look PBP, payback period.
All right. Okay. Yeah.
We can IRR,
Yeah.
internal rate of return.
Yeah.
We can ARR, average rate of return.
Yeah.
We can do sensitivity analysis. Okay, and we can do what else? We can do profitability index.
Okay.
We're not doing all the method, but we can dividend growth model.
Yeah.
We heard about CAPM, capital asset pricing model.
Yeah.
And yes, these are the key models. WACC, weighted average cost of capital. So when we invest, we can look around, what will be happen. And more crucial is look around gearing ratio. What effect will be on the gearing ratio? So always, even we don't discuss anything else, but we can discuss what effect will be on the gearing ratio. Because you are proportionate between equity and the debt. So what we said during previous lesson, we said debt is cheaper than equity.
Yeah.
Because the debt is tax allowable expense, interest on debt, and thus we can deduct it, we can reduce the profit, and ultimately we'll save on the tax as well. So that's we can look around as a return as well. So this we can, and of course we can look around the market analysis, what other factors will be impact all investments. So we'll go through different theories of investment. So LO3 is inductive content, which I just mentioned, motive for investment, return and return, risk and return, pricing, securities, market efficiency, money market investment, markets and investors, security quoted on, and all these are the key, and all our assessment criteria, which I just mentioned you, and investment decisions. So what is the financial management? So financial is dealing with the money, and the management, we need to create an environment. Definition of management. How you define on management? What is meant by management?
It's basically to do with control, like controlling costs,
So we'll say management is a controlling, management is a planning, management is a organizing,
decisions,
management is decision making.
Yeah. Okay. To do with performance as well, monitoring performance.
Yes, so all these are factor of management performance. So if you're a manager, so management is a process of designing an environment to achieve predetermined, or we call pre-selected objective. So because management, if you're a manager, you're supposed to be, management is a process, yes?
Yeah.
So you have to design an environment, you have to lay out your infrastructure to achieve your predetermined objective from various alternatives. Yes, we have different how you deploy your resources to achieve. So financial management is concerned efficient acquisition, you acquire, deploy both short-term and long-term financial resources to ensure objective of enterprise are achieved. Yes, so we looking in terms of the financial. So decision must be taken in three key areas. Investment. So we need to make an investment decision, both long-term in the non-current asset. Do we know the non-current asset?
Sorry, non-current assets. Yeah, they're long-term ones there. For example, fixed assets, plant equipment, machinery, furniture, fitting, property, something. And they're long-term, and they're kind of used in the they're what you call it. They are depreciated, which is a profit and loss. Basically.
Brilliant, well done.
Yeah.
Machinery, investment in property, these are the long term we call capital investment. Short term asset is a working capital like inventories, like stock. Those carry on changing in a year, so that's called short term.
Yeah.
Then the decision, it can be financed, from what source should be fund will be raised. You use internal financing, you will use external financing, you will use debt financing, you will use equity financing. All is part of the investment decisions. Dividend. How should cash funds be allocated to the shareholders? You will give them more shares, you will give them more dividend, what will be? So that's why consistent dividend growth policy need to be in place. Don't give the too much dividend a year and don't give them next year no dividend. That will is not create the trust of the shareholders. So we need a constant policy in place. Yes, maybe 2% increase every year or 5% increase every year. Whatever your decision will be based on your return.
Should be consistent, shouldn't it? If the company.
Yes, consistent growth policy. It's not 10% you're giving extra one year and 20% you're reducing next year, 30% you're giving more. So it need to be, even you're not earning profit, that's why you can pay them return profit.
Yeah.
Okay, so investment decisions to operate all the business will need finance, and the part of the financial manager role to ensure that finance is used efficiently, effectively to ensure the organization objective are achieved. Investment appraisal, we learn how to do appraisal, so I'm not going appraisal side, but we can use NPV, payback period, IAR, ARR. Those are the crucial. Of course, we can do sensitivity analysis or the profitability index. For the business to be successful, identify, implement successful project, survive day-to-day working capital management. Always we need to look around cash, payable, receivable days as well. The investment decision, financing decision when you make. So you need to, before a business can invest anything, need to be some finance. And the key financial decision, identify the most appropriate source. I earlier discussed dividend policy. We need to make sure is a consistent, and we can use different models to analyze. So I copied few things and the links for the reading. So capital structure, key consideration, ongoing servicing cost. Yes, if we are investing, we need to make sure maybe the servicing cost involved as well. We need to account when we'll make a decision to invest in anything. Issue costs. If we are issue shares, maybe issue costs we need to pay to brokers. They will attract, and of course, we're not getting the money which we are saying. 10 million shares we're issuing, maybe we'll not get the 10 million cash, because of course we are paying the fees. Gearing ratio, optimal capital structure, availability, tax flexibility, cash flows, risk profile, and all we need to look around. The theories we have, traditional theories, optimum gearing level, how much gearing can be the feasible. MMM is called Miller and Muldiani model, which we'll go through. And the tax, gear up as much as possible. Bankruptcy risk can be, if we have a too much high gear, it can be leads to we can be a bankrupt because if we don't pay it. Then we have a practice static trade-off. pecking order is sort of theory as well, which is picker is theory is compromise, agency effect. What is meant by agency theory?
Gosh, I can't remember. I haven't seen these slides. Are these slides new? Because the number I have looked at the you let different.
So like a director or the agent for the shareholders.
Oh right, that is. Oh right, okay. Yeah.
And they should be work in the best interest of
the owners, of the shareholders.
Of the shareholders.
And
So
the agents are the board of directors.
Yes. So they select on the board of directors, shareholders.
Yeah.
Okay. So my business valuation and the market efficiency, how we can approaches available, valuing shares approach, asset based, book value, net realizable value, replacement cost.
Yeah.
And this value we can measure the income and earning based, a price per earning per shares, earning yield basis, cash flow basis, DVM, dividend evaluation model, and DCF is called discounted cash flow model. Then valuing of debt, irredeemable, redeemable, preference, convertible, as we can look around. Market efficiency, inefficient market, weak form of efficiency, semi-strong, and strong. These are the forms of market efficiencies. Business evaluation, when we do approaches are available, we can look around the valuation of shares, irredeemable, market value versus 1 hour R. R is normally we known as a return. Preference share, PO is a base year, D is a debt, KP is the cost of preference shares. Redeemable is a present value of discounted rates which we'll get in future. Convertible, those can be converted either into the debt or into other shares, can be convertible. Valuing of the shares, we can asset based approach like earlier we said, income earning based approach, and these are the formulas we can use as well. Okay, efficient market hypothesis. Have we ever heard? What is meant by hypothesis?
Kind of where you're looking at the thing.
Yes, hypothesis is like a research.
Suggesting that something might happen or may not happen.
Yes, well done.
What happens if
Yes, it can be anything regarding research question. Yes, hypothesis which we want to test. Maybe we heard about t-testing, ANOVA, analysis of variance, and those sort of things. We can t-testing, least square method. Okay, so market efficiency, rapidly, rationally incorporating new information into share price. Market efficiency is efficient. You have information, new information. What is happening Brexit? What is happening yesterday between Boris and other leaders? A bit discussion. What's happening between UK and US? The trade deals. Yes, the information quickly, new information into the share price. Cannot be sustainably outperformed and must unless have information not generally available. If it's available quickly, we need to reflect and prices need to be readjusted. So benefit, investor confidence, performance reflect in the share price. Source of information, past price. Past price is available, the information, what was the previous trend of the shares, newly public listed information, newly public information, which is available, new information, revalue of the shares, and still private information that is available, what the company is going to make the decision, which is our internal, which we can give to the external, that will help them to make the decisions. So weak farm efficiency. past price pattern incorporated in the stock market. Just the pattern we looking, what was the last year in the month of July? Yes. In the July, what's happened, share, that's only the past information. We're not looking, no, is the new government, new taxes, new rules, yes? So that is a weak form of efficiency. Then can be semi-strong form of efficiency. Semi-strong, not a strong, semi-strong. All public information incorporated, just the public information that's on the public domain, all we incorporated into the stock market. We're giving them all information in terms of the stock. Strong form of efficiency, all information incorporated, both past, present, and future. Whatever we have, we incorporate into the shares. So that's called strong form of, which is very difficult. It's not 100%, but up to some extent we can. Normally, then paradox, of course, naive investor can cause unusual price swing. Investor needs to be believe and else's work to keep the market efficient. Because sometimes some high investor, they can manipulate the things as well. Yes, they can sell or they can buy, and they can increase the demand and supply, and ultimately the share prices can be changed. The market share price fair, and we can look around the net value of the project. Market investor cannot beat the market, of course. Practical consideration, valuation can be affected by the lack of liquidity, information, and market in equilibrium. Like we have a monopolistic. We know monopolistic, and oligopoly. Yes. So these economic concept we can embed. So when we look here, if we want to read further behind, I copy the link, so we can copy this link into, not put, because otherwise so many slides will be. So I try to keep it simple. Can you see it there?
Yeah.
So that's the chapter. We can look around. What is the capital structure, theory, practice, and agency effect? A financial information manager. So we can look around the issue cost, gearing, availability of sources of finance, theoretical consideration, lower risk. Yes, so we need to tax relief. We can look around interest rate, weightage average cost of capital. We can look around reduction in weightage average. So traditional views, at the lower level gearing, equity holders see the risk increase. At the marginal, as the gearing rise, so the cheapest of the debt issued dominant, resulting at the lower weightage average cost of capital. Because normally debt is cheaper than equity according to this theory. Yes, we need to be focused, and we can look around cost of equity, cost of debt, and cost of issue, and we can look around the overall capital and what's happening between debt and equity ratio. It will be move up or down on the graph. Then the Miller and Moriarty, they gave the theory with the tax effect as well. So we can look around the theory is based on exemptions such as the perfect market. What is meant by perfect market, capital market?
It's just they're homogeneous.
So perfect market is meant by in economics. There is no restriction. Any company can join in and can leave, and the market price is decided by the market forces. That's the perfect market, which is in real world is not, because somewhere is a government can intervene it. Yes, government can increase the tax rate. Government can reduce the interest rate. Yes.
Yeah.
So that can be so. So the starting point of this theory, as the investor are the rational, and the required rate of return of equity is directly linked with the increase in the gearing. The gearing increase the cost of equities increase. However, this is adjusted to reflect the debt interest is the tax deductible. So overall cost of the debt of the company is lower than according to the Miller and no tax. Because if it's a no tax, yes, so we can save on the tax, which is a 20% tax for suppose, yeah. So if you're issuing the equity, because equity won't be part of your debt and you can't deduct from your profit, which is not allowable. So that's why it's meant by lower the debt cost implies the less volatility in the return for the same level of gearing and giving the smaller increase in the cost of equity. Increase in the cost of equity does not offer the benefit of the cheaper debt. Therefore, the weighted average is false. So we can use the formula and we can calculate as well cost of debt and cost of equity. If we increase, what effect will be. So according to M&M, we in practice firm really found very high level of gearing. We can look around the bankruptcy risk can be agency cost, yes, between agent and other agents, tax impact of borrowing, our debt capacities, and all these, Then the other theory is against this theory as well. Then a lot of examples there. I'm not going through all, but cost of debt, benefit of debt. Then this picking order theory, which is meant by this is the separate theory. They're looking the issuing cost. Internally generated funds have lowest issue cost. So if you internally demonstrate the issue cost and the equity, the highest, the firm issue as much as they can. So they're saying, we need to look around the issue, lot of in favor and against some authors dealing with the gearing drift. We can look around as well, signaling to investors that giving, the company not going to borrow from outside. They have their own asset they're investing, like a return earning. Return on capital employed, you can calculate. Agency effect, you can look around as well, because agency effect can be because of course it will borrow and some agent will deal for it and they're not efficient, so that will affect on. So these are different theories we can look around, and the capital structure at the firm and some numerical there if we want to. Any question? Because the last lesson we will evaluate, so we'll use all these tools.
Because there's a lot of information there. How many work?
Can you see now?
Okay.
Yes. So in the last lesson we evaluate, because we'll go through different securities and we'll use different tools to evaluate all these we're discussing. So gain and the losses. Some investment can be very successful. 10,000 invest in September, for suppose it's a quite old example I pick it. Last minute it's like website. So what's happened is went up and invest in, and then would be worth off in September and onward. But we need to look around the present value as well. We're saying what you invest, what you get, what's happened in the period of time of the cash flow, what real value will be. So that's why it's come gain and the losses. But the past performance is very poor, guide the future performance. So despite the recent headlines, we can look around in the past. Yes. So what's happened is, because the past performance maybe is very poor, but the future, is it past performance always reflect the future performance? We say that's why some maybe we discuss star method of interview. If you apply anywhere job nowadays, company use the star method of interview. So why they use this method?
What?
Star method of interview.
What is it?
Do we know the star? What is meant by?
No.
Okay, star S stands for situation.
Yeah.
T stands for task. A stands for action, and R stands for result. So normally the people say, give me example from your past events where you exceeded and you achieve. Yes.
Yeah. Okay. Fine. Yeah.
Give me examples when you can't achieve it, what you learn from it. So because they say past performance reflects the future performance.
Okay.
So in the market, we can look around the past performance of the company for making the future. So again, this just some reflect of the graph variability. Variability means the change. The essential feature of the stock price is unpredictable variability, even when the averaged into the index, and this variability is apparent. Portfolio management is about the coping with the variability. Portfolio, don't invest into the one. Yes, you're investing in different types of securities and different industry. You're investing in oil, you're investing in, because your can be average return, your can be higher. So you need a good balance of it as a investment. So variability can be in different period, stock exchange. So financial investment, there are numerous component of financial investment. Market, where assets are bought and sold, and the form of trade. Security, the kind of securities available, return and risk. Investment process, the decision about which security and how much of each we will sell it. The financial theory, the factor that determine the reward from the investment and the risk. So market is any organized system for connecting buyer and seller. So market is a place where buyer and seller exchange something. Yes, we call the market. There are the many security markets. Market may have a physical location or existing only on the computer network. And the market varies in the security they are traded and in the way securities are traded. Characteristic of market, which we discuss about primary market, are the security where the newly issued securities are traded. Secondary market is a market where the securities are resold. London Stock Exchange is a secondary market, and most activities are the stock exchange is in the secondary market, most of. So the trades on the primary market, we can look around the capital for firms. Trade on the secondary market, don't raise additional capital for the firm. Of course, they already issue the share, somebody buy it, no, they are selling between individuals. So it's the liquidity to the primary issues, and the news, what will be the lower value if could not subsequently traded, it can be. Okay, a second way is to classify the market into call and continuous. In a call market, trading takes place at a specific interval. Some calls market have a provision that the limit movement from the prior price, and this is to prevent the temporary order. What is meant by call? Do we know the call?
No, I can't. No.
Okay, sometime, we have a lot of money spare. We said, we earlier mentioned equity is expensive than the debt, yes?
Yeah.
So what we can do, we can buy the shares call back, yes? So we can call our shareholders and we can buy the shares from them.
All right, okay, yeah.
So then, of course, because end of the day, equity is expensive. So what we have a spare cash, if we will deposit money into, we'll lose the money. Why not? We'll buy our own shares back and we pay the money higher than, then of course, in the future we'll save it.
Yeah.
So money market asset with the life are the less than a year, and the capital market where we can invest in the capital projects. Some assets, like most of the bonds, have a fixed lifespan, and the common stock have an indefinite life. So indefinite is not mean you need to be end any duration. So common stock normally ordinary share, that's known as a common stock. Broker, we know the broker is a representative appointed in investors. Broker have conflicting roles. An advisor, a broker can be offered investment advice and information. Salesperson brokers are rewarded through the commission. So what do you think? They will work in which interest, they invest they work according to their interests. They prefer, oh, you invest in this company, you will earn more.
I think they'll work in their own interest, but then there are regulations as well. But I mean, that's if they're buying at the stock exchange. But if brokers, I think, will work on their own, and they can get out of it.
So they have to be. That's why here marketing concept comes. Is a satisfaction of customer is a key thing. Advisor. So you not look your commission. You need to look around the long term your relationship. Because if you gain it, you will come to for further investment with the brokers. So if they not advise you financial advice, right? So what we will do, you not use them their services in future. That will be negative effect on their credibility. So they will lose in the short and the long term basis. We need to look around. Discounted broker offer the restricted range of service at the lower price. Complete a trade additional brokers. We need all these are the brokers. And the security. Standard definition of security is a legal contract representing the right to receive the future benefit under the stated set of conditions. The price of the paper defining the property rights held by the owner and is the security. Does it make sense of it?
Yeah.
Discounted brokers offer a restricted range of services at the lower price. Complete the trade additional broker needed, and floor broker is located on the floor of the exchange and does actually buying and selling, and specialists ensure the trade happen by holding inventories of the stock and posting price. Security money market, security short-term debt, and treasury bills. The least risky, of course, is giving security from the government and similar bills. Normally the government when government need money, they can issue the bonds as well. And that bond can be secure about against the foreign currency, against various other asset which is government owned it.
Yeah.
And treasury bills all considered have no risk default, have the short-term maturity, and have a known as return. T-bills is the closest approximation to exist risk-free investment. Yes, that because the giving the security. Like your deposit money in the capital market security instrument have maturity greater than 1 year. Fixed income securities have a specific payment schedule. Bonds promises to pay specific amount at specific time. Failure to meet the specific payment put the bond into default with the remaining payment, and the creditors can put the defaulter into the bankruptcy. So security, fixed income security differ from each other. Promise the return for the several maturity of the bond, credit worthiness of issuer, and the tax status of the bond. Bonds come under what? Is come under equity or debt?
Bonds are under debt.
Yes, well done. So bonds come under debt. Income and the capital gain are the taxed differently in the many countries, and the bonds are designed to exploit these differences. Treasury notes. Sometimes government bonds can be totally exempt from the tax because government want to be promoted and government want to invest in the welfare project, and the government issue the fixed income securities over the broad range of maturity. Both notes and the bonds pay interest twice a year. and they repay the principal and the maturity date. We know the principal amount, we know the maturity, of course, maturity always, and date, the face, it can be less than the face value when we'll buy this bond. Corporate bond, promise to pay interest at periodic interval and the return principal at the fixed date. You can't draw the principal amount which you invested, but you can carry on getting interest until 5 years, 10 years. It can be. Shares and equity, we know the difference between them. Derivative instrument are the securities whose value derived from the value of underlying security basket of securities. We discussed last lesson as well.
Yeah.
Instrument also known as contingent claims. What is meant by contingent? Contingent means second plan, yes?
Yeah.
So it can be second sort of securities. You can underlying asset can be secure of it. If you can't get it, we are happy to pay you this through. You can sell the asset. So these are the future is obligation to buy and the sell particular security of bundled securities. Future simply delayed purchase and the sale of the securities. Corporation can issue contingent claims. Corporate issue contingent claim including the purchase of the common stock from the corporation at the set price. So they have a right to swap it. Indirect investing. What is meant by indirect investing? Not directly but indirectly. Yes, purchase of the share, investment port, mutual funds. What is meant by mutual funds?
I don't.
Like a mutual fund company, they have a joint securities. Yes, joint investment, mutual interest.
Yeah.
Usually in the line stated policy objective. Unit trust invest depositor fund in the bonds. Equity size is determined by the flow of the fund. Investment trust issue a certain fixed sum of this stock, raise the capital. Fixed capital is be managed by the trust. And the hedge fund, we know the hedge fund companies as well.
Yeah.
Okay, so normally return, we can use the formula return. Value of investment, initial investment VO. V1 is known as the final value of investment. R is the return. What is the value of final investment minus the value of initial investment? The difference divided by the base. Like we saying last year sale and this year sale. If you take the difference between two and you divide it from the base year time by 100, you can find how many percent increase or decrease. Does it make sense?
Yeah.
So as long we know the value, yes, that's why we need to record it. Example, an initial investment of 10,000 is made. 1 year later, the value of investment has risen. So what is now, how many percent we have increased?
Sorry?
If we'll see the example, how many percent? So we have increased 25%, yes? So difference front invest value and past value when invested and divided by the base. Base, we always divide by the base. So an initial investment cost and 3 months now. So what in rate of return we have is a 20%.
Yeah.
Okay, so return and the risk. The risk is inherent in the holding. What is meant by inherent? Because it's called the systematically. The security itself is a risk, yes?
Yeah.
It's an inherent risk. The security is variability, uncertainty, its return. So factor that affect the risk is maturity. Underlying factor, more chance of the changing over a longer horizon. If the maturity is a longer, is a more risk. So you should expect is more return as well. Maturity value of the security may be the inflation. So what is the inflation? So if you're getting after 20 years, So think about it, the 3% inflation times 20. Yes. So actually, so if it's a 3% inflation and somebody say you will get the money back in 20 years.
All
so
right,
3% in 20 years. So times the 90%, yes. Sorry, 60% your value will be down. Real value of the bond or real value. So increase the chance of the issuer defaulting longer time. So never know. They are promising, but in 20 years they will default.
Yeah, before it, yeah, absolutely, yeah.
Return and the risk credit worth.
Yeah.
Yes, so credit scoring is worth it. Junk bonds, we can look around credit worthiness. What is the company asset? Like think about Amazon, think about eBay. What their asset they have? Few warehouse and one website.
Okay, right.
So is there any back asset? No, nothing really. It's very risky investment in a way. So if we are investing in BP, they have an oil well.
Yeah.
And they will be carry on number of years in the long run.
Yeah.
Even the company will be sold and not earn it, but still is worth it, yes? In the gold, in the mines. So these are technology companies, very risky investments. So if the technology fails, it fails, yes? So we can priority the bondholder may have a first claim of the asset bondholders because the bond are the debtors. But if you're a common stockholder, if the company liquidate, who will going to be get the first?
Well,
What
they'll be anything left over there, yeah.
So always debt holder will get the first.
Yeah.
The suppliers will get, employees will get, and anything left afterwards will get by the shareholders.
Yeah.
So underlying activity, the economics activity, of course, we can look around the fact. The greater the risk of security, higher is expected return, which we earlier mentioned. Set of investment of policy, objective amount and the choice of the asset. Conduct the security analysis, examine the security, identify those which are the mispriced, and use technical analysis, examination of the past price, trend, fundamental analysis, true value based on the future expected return. Does it make sense?
Yeah.
Okay, so portfolio, identify asset, choose the extent of diversification. Portfolio evaluation, assess the performance of. So what you can do if you want to assess the performance, maybe each type of security, like, we issue the common stock. So that common stock we invested in new machinery, and what new machinery generate, the productivity.
Okay.
And we can measure the performance. Portfolio revisions, yes, repeat the previous 3 steps, which we'll carry on doing. Open account with the brokerage and specify name of firms, buy or sell, size of order, and how long until order is cancelled, and the type of order, like which security. Time limit, broker should be attempt to fill the order, day order, filled during the day. Open order are the goods sales to cancel remain affected until filled or cancelled. Fill or kill, cancel. These are the terminologies we use, in term of buying. Yes, common stock. Discriminator order left to brokers, and brokers will do. Types of order, market order, buy or sell with the brokers, the best effort, the price uncertain. Can be a limit order, a limit price is specified. That's why, auto trade and auto buy, you can put the limits on the stock, when the system will do, when it's happened, like in the credit crunch, a lot of people were struggling. So they introduced the limit system. So you can put the limit. You can say share was £1.50. If it goes £1.70, it will be auto sell.
Okay.
If it drop £1.40, yes, it can be auto buy or auto sell, yes? So
Yeah.
you can set the limits, huh?
Yeah.
Types of orders: stop order. A stop price is a specified. Sell if the fall below is the same thing which I said. Buy if the price rise above. Execution is the certain if the stop price passed and the price is uncertain. Stop limit order. A minimum price is placed. Maximum price is placed. Price is certain with the range. We can give them a range. The execution can be uncertain. Margin. Yes, you can keep your margin. You know the margin. Yes, we know the margin and markup. Yes, so we can look around the margin. We hypothecations agreement. Broker can pledge the security, different types of securities, and we can look around held and street name owner legally by the broker and the dividend voting rights reports to go investors. Margin purchase, actual margin, market value of the asset minus loan divided by the market value. We can calculate the margin. Yes. Margin accounts. A margin is marketed marked to the market at the end of each trading day. Yes, what margin, what actual,
Yeah.
what start, what we. So it can be carry on chaining the cash return. 65 we purchase, 50 we purchase, 65 is sell. So today is 30%. Yes, cash return can be. So that's why the high return is one day is maybe return on the margins. So total cost, interest rate, initial margin, so the loan, and return is increased. So we can measure the return from the date and till now and how many percent really, yes. But if the price falls, margin return, what will be happen? It can be falls from 42 to 40.7. It depends, how much is the fall. A short sale is the sale of security. You don't own it. This is achieved by borrowing share certificate from someone else. Borrowing process is arranged by the brokers and allows shares to be borrowed. The broker either use the shares held in the street name and borrow like Walmart Street and various others, yes.
Yeah.
And the short sale, short seller A, then initial owner B. This is whole process, yes.
Yeah.
Pay price, receive stock, told owner firms, brokers, cash for dividends, and that's the voting rights can be.
Yeah.
What is the margin? Yes, we earlier discussed.
Yeah.
So that's all about. So today we discuss about different types of securities and we discuss the process. So risk and return can be evaluated by looking the various factors. So we can explain investment theories as well. We can discuss that. We can evaluate securities and critically review and underlying the concept, market analysis and efficiency. Yes, is based on various factors which we just mentioned. Any question? Any question?
Part A, on the spot. The spot rate. How do we their formula? Part A of the assignment.
Oh, part A assignment.
Yeah.
Okay, sorry, I'm not checked myself assignment. So we'll do is a marking sheet. Sorry, yes, assignment brief.
It's in the last page of it, in technical analysis.
Okay, so Same is holding a new factory. England, they must pay the final payment 9,000 in 6 month time. You can, the spot rate, euro exchange rate is this, 1 year forward exchange rate, 1 year. So prepare the portfolio evidence, address the following.
Like part one, the first one. Like I can't remember how to work out spot rates. I'm sure they're very easy.
Yes. So if you explain the steps and compute the profit based on initial transaction 9 million. So briefly discuss your funding. So you're discussing the funding method, yes?
But I where to work out, the actual spot rate. It gives you the percentage now, and it gives you a year. It's not required to find
Okay. What I'm going to do, I'm going to prepare the sample answers for these, yes?
Yeah, just the first one. I'm okay with all the other 2, 3, 4. It's
yes.
just the
So
first
what I'll do?
The form, and maybe I'm okay with 2, 3, and 4. It's just
Yes, no problem. What I'll do, I'll prepare some, the key points, and the next lesson I'll go through the key points as well. So identify the laws and regulation. I think so. We discussed, the last lesson.
Yeah, we're going there. Yeah, absolutely.
So assess, where the numericals I'll go through, and
the know that.
Yes, that's fine. So I'll go through this. I'll calculate myself as well.
It's just the first one, part A, the calculation. That's all.
Yes, so I'll go through the calculation.
I'll be able to talk around it, no problem, and work around it. It's just
that's fine. No problem. And part 2 is
okay.
Review the regulation, policies, procedures, identify, analysis, review, issue.
Yeah.
The global key portfolio management relations.
That's fine.
That's, I think so, is more theoretical. There are no numerical such. You can embed it. Yeah. You can embed some calculations into justified your, yes?
Some of it already.
So because until now we're not done LO5, yes?
Yeah.
So, and when we'll go through our LO5 and 6, all will be addressed, yes?
Yeah. I've actually done part of 2, part of B already, and calculations in that, so I'm okay there. Part 1, part 1.
So no problem. What I'll do, the part 1, this A, yes?
Yeah.
And I'll go through. Yes, I'll go through with you. So what I'll do, I'll solve it myself, all possible option by looking the rates, yes?
Yeah.
And then of course.
Is there a formula for that? What is it?
Yes, we have a formula, so we just need to use the formula.
Yeah, great.
So I'll sort out the formulas in one slide. I'll send you as well, but I'll solve it and then we can go through the next lesson.
I'm going with the other part, and I have a lot of the involved. I just need to put it all together again, but I put a lot of work on it.
Yes, that's fine. No problem. We'll go through, these more.
Next week I will be in Cork, which is a different part of Ireland. Is there anything you could put up the slides maybe a day beforehand?
Yes, that's fine. So you just focus on the theoretical side, writing.
Yeah. Which I'm
so
doing,
I'll go through this bit, and then your assignment will be complete.
It's just part 1. I'm fine with all the other.
Yes, that's fine, because when we'll finish, at least, you have some input your end, and we'll go through this, the numericals, and by using the formulas.
Yeah, brilliant.
So that's all, we need to.
Yeah.
Any question?
No, I'm fine, thank you. And thank you very much.
No, you're welcome. And we'll go through this bit next. I not checked first. Okay, so welcome as you know, we'll finish this a bit recap. So today we discuss about types of security, we discuss return and risk and return, we discuss about pricing securities, we discuss strong, weak, and semi-strong form of market and market efficiencies, market and investor quoted and yield basis and discounted basis, all we discussed during this lesson. If you have any question, please drop me email. Hope so I will speak you all next lesson. So please carry on working on theoretical side of assignment, and numericals we can further discuss, and we'll solve, and I'll identify the formula those can fit with the scenario, and different formula of the securities we can based on the risk and return, based on the growth models as well, based on the different exchange rates, so those
I've done all that. I've actually
yes.
Figures for those as well, so I'm fine there.
Okay, brilliant. So that's numerical side which we'll go through the next. So that's that bit really.
Can you email me today's slides, please?
Sorry?
Email me the slides for today.
Sorry, which slide?
The first slide that you added in there today, you added in about 15 slides. I was wondering if you could email them. Thanks.
Yes.
Thank you.
Welcome. Sorry, it's a bit, I don't know what's the problem, either my end or your end. The voice is not clear, always broken, when.
Yeah,
so
if you could repeat the slide, please.
Yes. So all these, there, and I copied the link there.
Thank you.
And one link at the end, if you want to go through some yourself as well, you can copy this link, you can paste it, and which will go through next lesson, really will focus.
Great, thank you so much.
You're welcome, and have a nice weekend, and hope so weather will be nice, and enjoy. You. Great, we'll speak you next week then.
Yeah, thank you very much.
Okay, thank you. Okay, thank you everyone. So all this today, LO3 we discuss. So please, if you have any question, just drop me email, and have a nice time. Thank you. Bye-bye.